Everyone has an opinion about crypto. The people who made money think it is the future. The people who lost money think it is a scam. The people who never touched it wonder if they missed something or dodged something. The truth, the actual, honest, useful truth, sits somewhere that most of the loud voices on both sides never quite reach. This video is that truth. Let me describe a situation that has played out for millions of people in multiple versions over the last decade. Someone hears about crypto, usually from a friend who made money, or from social media during a period of rapid price increases. They research, but the research mostly consists of price charts going up and excited commentary from people who already own it and want it to go higher. They buy, often more than they planned, often at a price point that already reflects significant gains from earlier holders. The price continues upward for a period. They feel vindicated, smart, early, then it drops, sharply. Not a little, dramatically, 50%, 70%, sometimes more. They hold because selling feels like admitting a mistake. They check the price constantly. The anxiety is real. Some recover eventually if they hold through the cycle. Many sell during the panic at a loss. Some hold assets that never recover because they bought something other than the dominant assets, and it simply never comes back. This pattern, excitement, entry at elevated prices, crash, emotional decision-making, outcome ranging from recovery to total loss, has repeated multiple times in crypto markets across multiple cycles. Understanding why it keeps happening is how you avoid becoming part of the next version of it. Let me give you the honest framework for understanding what cryptocurrency actually is, the genuine case for it, and the genuine risks, without the hype in either direction. What cryptocurrency actually is, stripped of the noise. Cryptocurrency is a digital asset that uses cryptographic technology to operate on decentralized networks, meaning no single government, bank, or company controls it. Bitcoin, the original and by market capitalization, the dominant cryptocurrency, was designed as a decentralized store of value and medium of exchange. There will only ever be 21 million Bitcoin. That fixed supply, combined with increasing demand, is the core argument for its value. Ethereum, the second largest by most measures, is a programmable blockchain platform that enables decentralized applications, smart contracts, and a range of financial tools built on its network. Beyond these two, thousands of other cryptocurrencies exist. Most have significantly smaller networks, less established use cases, and far higher risk profiles. The legitimate case for crypto. What the honest argument actually is. There is a genuine case for Bitcoin as a store of value, specifically as a hedge against currency debasement in countries with weak monetary systems or high inflation. For people in countries where the local currency has historically lost value rapidly, access to a deflationary asset with a fixed supply is genuinely meaningful. Institutional adoption of Bitcoin increased significantly with the approval of Bitcoin ETFs in some major markets, making it accessible to mainstream investors in a regulated wrapper. This represents a meaningful shift from crypto's early positioning as purely a fringe asset. The blockchain technology underlying crypto has genuine and expanding use cases in finance, supply chain, digital ownership, and cross-border payments. These are real. They are not fabricated by enthusiasts. The genuine risks? What the honest case against careless crypto investing actually is. Volatility is extreme and structural, not temporary. Bitcoin has experienced multiple drawdowns of 50% or more from peak prices. These are not anomalies. They are a recurring feature of the asset. An investor who cannot psychologically and financially absorb a 50% drop should not hold cryptocurrency at meaningful portfolio weights. The altcoin market, everything outside Bitcoin and Ethereum, has an overwhelming historical failure rate. The vast majority of the thousands of cryptocurrencies created since 2009 have lost most or all of their value. Picking winning altcoins requires either extraordinary luck or information advantages that most retail investors do not have. Regulatory risk is real and unresolved in many markets. Governments globally have taken varying positions, from embracing crypto infrastructure to outright banning trading and ownership. The regulatory environment in your specific country matters, and it can change. Custody and security risk is unique to crypto. If you hold cryptocurrency directly and lose your private keys, your access is permanently gone. If you hold on an exchange and the exchange fails, as has happened multiple times with major platforms, recovery may be impossible or partial. These are risks that do not exist with regulated investment accounts holding stocks or ETFs. The information environment around crypto is uniquely polluted. More than almost any other asset class, cryptocurrency markets are influenced by social media, influencer promotion, coordinated pump activity, and motivated reasoning from people with financial interests in the price going higher. Separating signal from noise requires active skepticism that most newcomers do not initially apply. Let me show you two investors. Same starting point, different approaches. Investor A, unstructured crypto exposure. Invests $3,000 into a mix of Bitcoin, Ethereum, and three smaller altcoins during a period of market excitement. No predetermined exit strategy. No position sizing relative to overall portfolio. Allocation represents 40% of their total savings. Over the following 18 months, Bitcoin and Ethereum experience a significant correction. The three altcoins lose 80 to 90% of their value and do not recover meaningfully. 18 months later, the total portfolio value is approximately $1,100, a loss of approximately $1,900. The loss is not only financial. The psychological cost, the constant price checking, the anxiety, the impact on other financial decisions made during the period is real and not captured in the number. Investor B, structured size crypto exposure, invests $500 into Bitcoin only, representing 5% of their total investable assets. They understand going in that this position could go to near zero, and they have sized it so that outcome would not materially damage their overall financial position. They do not check the price daily. They hold through volatility. Their core portfolio, index funds in tax-advantaged accounts, continues compounding regardless of what the crypto allocation does. Over the same 18 months, their $500 Bitcoin position drops to $280 at the low point and recovers to $640 by month 18. The outcome is positive. More importantly, it was never existentially threatening to their financial plan because it was sized appropriately. The difference between these two outcomes is not which asset they chose. It is position sizing and structure. Here is the honest framework for deciding what to do with crypto, if anything. Step 1. Establish whether your financial foundation is in place first. Crypto is a high-risk, high-volatility asset. It belongs, if it belongs at all, after your emergency fund is built, your high-interest debt is eliminated, and your core index fund investments are running. It is never the foundation. It is never the emergency fund. It is never money you might need within 5 years. If your financial foundation is not in place, crypto is not the next step. Build the foundation first. Step 2. If you choose to invest, size the position to survive total loss. The honest position sizing question is not, how much do I want to invest in crypto? It is, how much could I lose completely without it materially affecting my financial life or my ability to continue investing in my core portfolio? For most people starting out, this is somewhere between 2 and 10% of investable assets, not 40%, not your emergency fund. If total loss of the position would not change your life, the position is sized appropriately. Step 3. If you invest in crypto, stick to the most established assets. Bitcoin and Ethereum have track records, established networks, and significantly larger liquidity than altcoins. They are not safe. No cryptocurrency is safe in the conventional investment sense, but they have meaningfully different risk profiles from newer, smaller, less established assets. Altcoins with no proven use case, small networks, and heavy reliance on narrative rather than utility carry substantially higher risk of permanent loss. The more speculative the asset, the smaller the position if you hold it at all. Step 4. Use regulated access points where available in your country. In markets where regulated cryptocurrency, ETFs, or exchange traded products exist, these provide exposure to Bitcoin or Ethereum through a regulated, custody managed wrapper that removes the private key security risk. Research. What regulated crypto investment products are currently available in your specific country? This landscape has been evolving. Verify current options and their regulatory status before investing. If you hold crypto directly, use only established, regulated exchanges. Research the exchange's regulatory status, custody practices, and insurance arrangements before depositing funds. Never hold significant amounts on unregulated or obscure exchanges. Step 5. Decide your exit framework before you enter. One of the primary reasons crypto investors lose money is that they enter without a plan and make exit decisions emotionally, either selling in panic during downturns or holding through full cycles waiting for prices that never return. Before buying, decide two things. What percentage gain would cause you to take partial profits and rebalance? What percentage loss would cause you to exit regardless of your conviction? Having these numbers decided in a calm moment, before the emotional volatility of price swings, produces better outcomes than making those decisions in real time under emotional pressure. Here is the honest reframe. Cryptocurrency is neither the financial revolution that eliminates the need for everything else, nor a worthless scam with no legitimate basis. It is a genuinely novel, genuinely volatile, genuinely useful in specific contexts, genuinely risky asset class that has produced extraordinary gains for some people and devastating losses for others. The difference between those two outcomes has rarely been about which coin someone picked. It has almost always been about position sizing, entry timing relative to cycle position, exit discipline, and whether the crypto allocation was built on top of a solid financial foundation or instead of one. Treat it as what it is, a high-risk allocation that belongs at the edge of a portfolio, not at its center. Size it so you can sleep through the volatility and build everything else first. The truth about cryptocurrency in 2026 is not that it is going to make you rich, and it is not that it is worthless. The truth is that it is a volatile, evolving, genuinely complex asset class that can have a legitimate role in a portfolio, sized appropriately, accessed through regulated channels, built on a foundation of better established financial decisions. The people who have benefited from crypto without being destroyed by it share common characteristics. They treated it as a small percentage of a larger portfolio. They invested only what they could afford to lose. They used regulated, established platforms. They made entry and exit decisions based on a plan, not on social media sentiment. They built their financial foundation first. You now have the honest framework, not the hype, not the cynicism, the truth. What you do with it is your decision, made with clear eyes and real information. That is the only way any financial decision should be made. Drop a comment and tell me, what is your current relationship with crypto? Never touched it? Curious? Already invested? Or burned before? Tell me where you are and what question you still have. I read every comment, and I will give you my most honest answer. If you know someone who is about to put a significant amount of money into crypto based primarily on social media excitement, share this video first. not to stop them, to make sure they go in with the full picture. Subscribe to Nuella Invests. Every week, we give you the honest financial conversation, not the one designed to make you feel good, the one designed to help you make better decisions. See you in the next one.